Like other market movements, support and levels are the result of the psychology and behavior of traders. Bulls, who buy at support levels, and bears, who sell at resistance levels, are in a constant battle to maintain their market advantages. At the resistance level, interest in selling overtakes interest in buying. Buyers who entered their positions at the previous low are looking to sell and capture profits. This causes prices to start sliding downward. Those who did not exit the market are now watching their profits slip away. They'll look out for another upward movement so they can exit and take whatever profits they have left. When the opportunity presents itself and these traders switch to sell, this will create even more selling pressure, strengthening the resistance level and pushing prices down until buyers step in and provide support. At the support level, interest in buying takes over from interest in selling. Bullish traders expect prices to rise again and will buy as soon as they see prices holding at a support level. Some traders may recognize when prices are starting to rise again and buy immediately, pushing prices up more. Others may wait for prices to retest the support level again so that they can enter the market at a better price. When this happens, they'll jump in and buy, pushing prices up again and further strengthening the support level. If these patterns retrace themselves at the same prices, the support and resistance levels are said to be holding. When using the price action trading methodology, you want to buy when the market is buying and sell when it is selling. Using the 1-minute chart to identify support and resistance levels will help you better understand what the market might do next.
Support and resistance levels are not permanent. That's because they can be affected by a variety of factors, like a strong capital flow or expectations about a news event. Other times, in the battle between the bulls and the bears, one side may lose steam and give up, allowing prices to break through a level. The key thing to know is that when price breaks through a support or resistance level, the role of that level is reversed. A former support level will become a new resistance level, or a previous resistance level will become a new support level. In this example, prices have hit a resistance level and are moving back down. Buyers who bought at the previous low, but who did not exit the market when prices were up, will sell to minimize their losses. This causes even more downward pressure on prices, enough to break through the support level. For the bulls who bought at the support and did not take profit, they are now holding a loss. Therefore, when price pulls back to their entry price, they will close their trades and break even. Bears and neutral traders will also look to sell. Prices will begin falling again, which means that old support level is now acting as a resistance level. It is difficult to predict whether a support or resistance level will hold or break, but you can stay prepared by being aware of anticipated news releases, economic data, and other triggering events that might cause shifts in the market.
Support and resistance levels on different time frames have different significance. To understand how prices might move over the next 10 to 30 minutes, you should analyze support and resistance levels on a 1-minute chart. However, for a longer duration, like a few hours, you should refer to the 10-minute chart. On this 10-minute chart, you can see a resistance level and a support level. But for the price action trading methodology, this information is too broad. We need to look at the 1-minute chart and more precisely determine when buyers are buying and sellers are selling. Here, you can see the same support and resistance levels that we observed on the 10-minute chart. You can draw a support level on the 1-minute chart and confirm it by checking that it touches previous lows. Then, to see how respected the support level is, you can zoom back out to the higher time frame and look for other touch points. Note that those support and resistance levels observed on the higher time frame charts are more likely to hold. You will need to refer to lower time frame charts for more precision and opportunities to trade. That's why the 1-minute chart is necessary. To use price action trading methodology, you'll need to see what the market is doing at a specific moment in time, within the larger trend that you can see on a 10-minute chart. Understanding both time frames will help you make smart, ego-free decisions about when to buy and sell.
Congratulations on completing our series on the basics of foreign exchange trading. You now have the fundamental knowledge necessary for price action trading. You know how seeing prices in 3 dimensions gives you the ability to make profitable trading decisions. You know how to read 10-minute and 1-minute charts to determine both the market direction and the levels of support and resistance. And as your skills advance, you'll learn to read 10-second charts to enter trades with precision. But as the saying goes, practice makes perfect. The only way to become a confident and competent Forex trader is to actually practice making trading decisions. That's why part of this course includes practicing with a demo account in a live trading market environment. You can get real market trading experience without the risk of the costly mistakes you might encounter when trading with real money. When you're practicing, don't forget the mindsets of don't lose, don't hold, don't risk, and the trend is your friend. Remember, you'll need to manage your ego with the goal of living to fight another day. Before you know it, you'll be well on your way to becoming a consistently profitable foreign exchange trader.
You're almost ready to start practicing the fundamental trading skills you've learned so far. But before you do, it's helpful to remember the importance of trading with the right mindset. Professional traders discipline their skills with the right mindset in order to achieve trading success consistently. By internalizing the right mindset, you'll learn to apply your new skills and knowledge with the discipline necessary to make a profit with consistency. As you practice making trading decisions, remember, don't lose. Ask yourself if now is the opportunity to make a profit. If you're unsure, it's better to stay out of the market. Don't hold. Unlike investors who hold onto positions, traders think about where they can buy and sell quickly. Let's say you see the market is bullish and the trend has been confirmed. You can buy and sell quickly with the up move and gain 1 pip. Don't risk. Risk is quantified by time, exposure, and uncertainty. If the market has been ranging for the last 60 seconds, and it is unclear if the buyers or sellers are in control, then it's probably too risky. You're better off waiting until you have more certainty. The trend is your friend. Ask yourself which direction the price is moving, then remember, buy when the market is buying and sell when the market is selling. Manage your ego. Before you make a decision, consider if you're more worried about being right or about being profitable. You must leave your ego out of trading decisions. Even though the trader was buying in the midst of a downtrend, he chose to take a small profit instead of fighting with the market. Last, live to fight another day. If you find yourself in trouble, remember, it's better to be a living chicken than a dead duck. The trader continued selling in the downtrend, not knowing that the market is facing a strong support. Instead of holding the trade to wait for a profit, he cut the trade at a small loss. If he did not do that, he would have suffered a significant loss as a key reversal pattern forms and brings the market back up again. The foreign exchange market is influenced by many unpredictable factors that can change at a moment's notice. In those cases, it's not your skills that you'll lean on, it's your mindsets that will help you weather the storm and rise to success.